Peter Lynch, legendary manager of the Fidelity Magellan Fund, delivered an average annual return of 29% between 1977 and 1990. He often emphasized the importance of simple financial ratios in identifying high-performing stocks. For example, Lynch famously used the PEG ratio, price to earnings to growth, to identify undervalued growth stocks. He believed that a company growing at 20% with a price to earnings ratio of 20 was fairly valued, resulting in a PEG ratio equal to 1. If he found a company growing earnings at 20% with a price to earnings ratio of 10, he knew he had found a bargain since the PEG ratio would be less than 1. Lynch's success highlights how mastering just a few key financial ratios can lead to extraordinary returns. Financial ratios are mathematical comparisons derived from a company's financial statements. They allow analysts and investors to quickly assess aspects of a company's performance, such as profitability, liquidity, leverage, and valuation. Used correctly, they help compare companies across industries or monitor changes over time. Gross margin is calculated as gross profit per revenue. It indicates how efficiently a company produces goods. Operating margin is calculated as operating income per revenue. It measures how much profit a company generates from core operations. Net margin is calculated as net income per revenue. It shows the percentage of revenue left as profit after all expenses. Current ratio is calculated as current assets per current liabilities. It measures the ability to cover short-term obligations. Quick ratio is calculated as current assets minus inventory per current liabilities. It is a stricter measure of liquidity than the current ratio. Debt-to-equity ratio is calculated as total debt per shareholder's equity. It assesses financial leverage and risk. Interest coverage ratio is calculated as earnings before interest and taxes per interest expense. It indicates how comfortably a company can pay interest on its debt. Price to earnings ratio is calculated as price per share per earnings per share. It shows how much investors are willing to pay per dollar of earnings. PEG ratio is calculated as price to earnings ratio per earnings growth rate. It adjusts the price to earnings ratio for growth, which is useful for growth stock evaluation. Price to book ratio is calculated as market price per book value per share. It compares market valuation to net asset value. No ratio tells the full story in isolation. For example, a low price to earnings ratio may indicate undervaluation or poor future prospects. Comparing ratios within the same industry and understanding trends over time is essential for meaningful analysis. Using financial ratios effectively requires both numerical skill and a feel for the business context.